everybody knows everybody here. So it's Bill Ackman from Pershing Square, Jonathan Gray from Blackstone, and Joe Harvey from Cohen and Steers. Everybody, so we don't need any further introductions, so we will start. They're all very distinguished. Core assets have been on fire. We've had continued compression of unacceptable returns, and cap rates have come in quite substantially. And most of those investors do not employ any leverage at all, or if they employ leverage, it's very, very modest. So let's start. My question is for John. We'll start off with John. As core investors have driven down their expected return hurdles, and Boston Properties have just raised a new opportunity fund, can you get the same returns you've gotten in the past?
Well, look, our business, fortunately, is not buying core real estate, which has definitely gotten more competitive, and that's a function, of course, of very low interest rates. If you're a CIO out there today and you're faced with a 0% short rate and a 2% 10-year treasury, a 5% yield on a piece of real estate doesn't look so bad. You've got sovereign wealth funds who are looking at inflation and trying to move from bonds to hard assets. You've got REITs who are focused on core real estate. So there's an awful lot of capital on that side of the table. What we like is the opportunistic space. And the reason we like it is because there's still a fair amount of distress left from the 05-07 period. If you go back, you know, hundreds of billions of dollars of loans were originated. If you look in the CMBS market, something like 40% of the 05-07 loans are in some form of distress. Those loans need to work their way through the system. Those assets need to be recapitalized. And we've been aggressively focused on that. We put out more than $13 billion of equity in the last 2.5 years, all around those kind of situations. So you've got a lot of distress. And then on the flip side, unlike the core world, in the opportunistic world, most of the competitive landscape was financial institutions who, for a variety of reasons, are no longer in the business today. So the number of people who can write really large checks to clean up broken balance sheets, we bought Centro's U.S. assets last year for $9 billion. There wasn't a whole host of competitors to do that. So limited number of people to clean things up, a lot of distress out there. And then the supply picture, I think it's a little better than people realize. We can talk about it later, but what gives us confidence is the fact that no one's building new buildings. And if you can buy hard assets at big discounts as a result of this distress and believe a little bit of economic growth in the face of limited new supply, I think you can generate pretty good returns.
Okay. My question for Joe is many of the leading REITs own core assets, and the returns on core assets have come in quite a bit. Is it logical for REIT investors to lower their return expectations, just as the institutional world has lowered theirs in the face of the low rates?
Well, it's very logical, and in fact, it's happened. You know, REITs today are trading at a slight premium to what we believe their underlying real estate net asset values are. If you looked at a dividend discount model to try to look at what the long-term returns potential would be, you're in the 8 to 9% range. So as interest rates have come down, you know, REITs have repriced to reflect that. But I think the bigger story is that you know, REITs have deserved to be repriced because they've really proven themselves over a long term. And one of the most interesting dynamics is how REITs have gained market share compared with the private market. Because when you stack up the returns of REITs and think about the liquidity and the quality of management that you have, the returns have far exceeded what institutions have gotten. And
I don't care about past. I don't care about past. We're talking about the future, because the past performance is no guarantee of future results, as they say in every prospectus. Let's talk about going forward from today's price structure.
Well, they as I said, they're priced, you know, I think commensurate with where core assets are priced in the private market.
Okay, for Bill, you play in lots of ponds. You don't only play in U.S. real estate, you also play in the corporate sector, you play internationally. How attractive is U.S. real estate compared to your other opportunities?
So I guess I'd like to say I don't really deserve to be on the panel because I'm not really a real estate guy like these purists to my right, but the benefit of that is that we only invest in real estate if we think it's an interesting time. But personally, I invest in real estate. And so I get a little bit of perspective from that. And of course, we look at the public landscape. I would say the REIT sector generally is not something that we spend a lot of time looking at. We're looking for the one-off special situation where you can put a lot of capital. I think it's interesting about real estate. People complain about pricing, but I see very smart people doing great deals in New York City, which I think of as obviously one of the most competitive markets in the world. And if you can still do great deals in New York City of significant scale, then there's always interesting stuff to do. So I think it's a bit of you're giving up if you say that. I think if you're going to buy some core asset marketed by an investment bank that's fully leased and there's no work to do, you're going to pay a big price. But there's lots of distress or interesting opportunities that I do real estate part-time with my dad, and part-time we've done a lot of interesting things in Manhattan and in Philadelphia. And so if we can do it part-time, the full-timers can find things to do. I think the biggest issue for REITs is that they're no longer, or they're not really designed to be opportunistic entities. They're really designed, my perspective, almost like the mutual fund industry, where they've built certain specializations. They build a portfolio of Class A New York office buildings, or Class A apartments, or pick your industrial assets, allowing an investor to build an indexed portfolio. And I think that's a much more attractive, stable place to put capital than a lot of other alternatives. But it's not a place where I think it's hard to get the kind of returns that we want to deliver to our investors. So I think it's a very good strategy for a individual or for someone looking for diversification. I think it's a hard strategy at today's valuations to make a fortune.
What kind of returns are you looking for your investors?
I mean, high. I mean, we've delivered.
High, well.
Yeah, high. High. We're unlevered. We've had 18% of our assets in cash. We charge our investors 1.5 and 20, and we feel like, you got to leave them something meaningful in order to charge that much. So if we can earn a high return, I think our average return on invested capital over the last 8.5 years is like 36%. That's a big number. So it's got to be something really attractive for us to put money to work.
Okay. In the REIT world right now, there's a whole bunch of discussion of companies attempting to improve the quality of their portfolio, and they're buying and developing high-quality assets and divesting non-core assets. So, John, you've taken the other side of that trade, making acquisitions in higher-yielding assets like shopping centers, suburban office, industrial. So can you comment on why you're on the other side of the trade? And also, is a REIT IPO an exit strategy for you?
Sure. I think when you go through a financial crisis like we just did, investors got badly burned with a lot of things, particularly commodity real estate. They make decisions, and it's not just true in real estate, but in other asset classes, that some assets are good and some assets are bad. So Bill made an investment in JCPenney's, the department store business, which is a challenging business, but he bought in at 4 times EBITDA. And there's operational upside, and I think he's made a terrific investment. I think analogous to this in our world is some of the commodity real estate. Everybody has decided that owning core real estate in the best markets is the strategy to have. And as you've heard, what that results in is prices going up a lot, cap rates falling. So we said, well, if I could buy strip shopping centers or warehouses or even suburban office buildings, and I could buy them at 8% cap rates or higher in some cases, if I could buy them on cap rates on occupancies that used to be 94 and I could buy them 83 to 87% occupancy, so my implied value per square foot was 30 or 40% below physical replacement cost. We bought Centro's assets at $100 a foot, and we bought some office buildings from Duke Realty for $100 a foot and warehouses for the low 40s. At those kind of prices per foot, where we're buying at high yields, we're borrowing at, call it 5-ish%, we're getting a nice running yield, we don't need to believe a lot, and no one's building any buildings, which I mentioned before. And just to put that in context, in the U.S. today, Michael Billerman, who I see, does a chart that shows annualized new starts, and it's right around 50 or 60 basis points, which I would argue is around obsolescence. So you've got a $15 trillion U.S. economy. It's adding 2 or 3% in GDP. It's adding, call it 3 million human beings, 2 million new jobs, and it's not building any new buildings. And even commodity real estate in that kind of environment begins to recover. And we see that in our portfolio today. We see same-store releasing spreads up 700 or 800 basis points in our retail centers. We see occupancy growing even in places like Atlanta and Chicago and Dallas. If you don't build any buildings, good things start to happen. So I think investors look at the world today, and 2 or 3 years ago they said, you know, Washington, D.C. was the only safe place, and then it was Washington and New York, and now it's maybe the coast. At some point, I think they'll get comfortable saying, at a pricing level, I can own more ordinary real estate, particularly in this kind of environment, and that's what's given us the confidence to invest.
Is a REIT IPO the exit strategy, or selling it to somebody else?
Well, look, for everything we own, you know, we'll think about multiple options. So we may sell, in some cases, individual assets. We may sell to public companies. We announced, I guess, a couple weeks ago with Glimcher, our partner, we sold a mall for $350 million in Hawaii. You'll see us sell some assets and portfolios and merge with existing public companies, sometimes cash and stock. And then there will be IPOs of some of our holdings, just by virtue of their size and where we think we can get the best execution.
I was on a panel in Chicago yesterday, and the night before there was a keynote speaker, Lee Nybart of Area Property Investors. And he made a flat-out statement. He said suburban office buildings is a sucker bet. And he made the following analogy. He was involved with my namesake company, Schulman Development Company, which developed office space all in 287 in Westchester County. And in 1988, he was leasing a building there for $23 a foot with $6 expenses, so his net rent's $17. And you go in the market today, rent is $23, expenses are $13, net rent's $10. So after 25 years, you've gone from 17 to 10, a great investment. So is this a sucker bet?
Well, we obviously don't think so. You know, part of it, again, is price. I mean, the buildings we're buying traded for as much as $200, and we may be buying them for close to $100. And I again go back and look at the supply picture in these markets, and the fact that if you look at the returns, what we're believing basically, we get more than half of our return just from current income, and we're believing very modest assumptions in terms of rental growth or occupancy growth. So I'm not saying suburban office buildings are the same as owning something in West LA or New York City, but at the right price, I think you can make a sensible investment.
I think actually what Warren Buffett would describe suburban office buildings as a cigar butt investment, you know, not the super high quality asset, but I bet you wouldn't buy suburban office buildings if you couldn't finance them, right? The ability to finance them with non-recourse debt, earn a very high current return, get back, in effect, your capital, and have an option on the appreciation. It's the option value that's created by the debt that makes it attractive, whereas I think you would buy a Manhattan building unlevered.
There's no question that the financing today makes it easy to believe relatively little. So if you said that building is not going to appreciate, those set of buildings, even though they've fallen quite a bit of value, and it's not going to go back up at all, you know, in some of these deals, we can generate 13, 14% returns between current income and ROE with that option embedded. So I think it's a function of what we're believing. I would also say on suburban office buildings, when an asset class falls this far out of favor and nobody wants to put money into it, if there is job growth, I'm not saying in some Midwest cities that may be shrinking, over time those rents
Midwest is getting better, by the way.
Yeah, well, I was thinking of Michigan and Ohio and places where it's very tough.
You bought your position in some of the Duke assets, which I think sitting in the Midwest.
Yes, we got some of those, but what I would say is over time, hard assets revert to physical replacement costs. If you said in our business, how do we think about investing capital, that's what we think about. And these assets have to, otherwise no one will build new buildings.
Okay, now for Joe, are you supportive of the portfolio shift the REITs are doing by going to core? And then to follow up, to think about is there a place for REIT portfolio owners for secondary assets? Like, is there a company structure for secondary assets that would make sense for you?
Well, I mean, obviously it's case-by-case analysis, right? But I get very upset when I hear companies say that they're pursuing a strategy because that's what we want to see, or they need to check a box. And I think some REITs have made some bad sales of secondary assets. So I mean, we're all about making money, and you know, one of the biggest disappointments that I've had, coming out of the 2009 and the recapitalization phase for the industry is REITs had a huge head start on everyone else in terms of access to capital, and that's evolved into having tremendous access to capital at a very attractive price. And I think REITs have the platforms to be more opportunistic. One of the things with secondary assets is that I think you need two advantages. One is that you need to know how to buy right, but you need to have the financing advantage, and you need to have the platform to be able to lease the assets up. So I think there are many companies that fit that profile, and they've really not taken advantage of the lead that they had. And I think it's easy to say, well, in hindsight,
Hindsight is very easy.
But it became pretty apparent that we were going to have a cycle where the can was kicked down the road, but that in order to get at these assets, you had to get at them through the debt. And I think that REITs had a great opportunity to assemble teams, to have that expertise and go after assets through the debt, and not many have.
I think actually part of the reason for that is, the focus on generating quarterly adjusted funds from operation, right? If you buy a defaulted debt security and it's a 12-month workout to get to the asset, and you can't record any income, right? You're using capital, you're not returning any FFO to your investors, and it's probably a place where the market doesn't give you credit for it. And my guess is if you've got a management team, or if you read in the proxy, their compensation is based on growing per share FFO each year, it's probably hard for them to make the decision to go out and take a bunch of capital in which they're going to earn zero for 18 months.
But the thing is if a company doesn't make FFO for, say, a couple of quarters because they're doing something that may be creating long-run value, portfolio manager at the end of the table will shoot the company and sell the stock, right?
I completely disagree with that. I mean,
I got some CEOs
you
here
look
who take
at
the other side of that.
You look at how much the buy side has evolved, and how deep the infrastructure is for real estate security investing. And I think that's one thing that's not appreciated when we talk about topics like this, or whether you can do an IPO or not. What's not understood is that there's significant demand for these types of portfolios all around the world. Many different types of investors, sovereign wealth funds, retail investors in Japan, investors who are looking for real asset strategies. So this is very deep, and relating to that, you have a significant buy-side infrastructure, smart people who know how to figure these things out. And I do think that one of the negative aspects to meeting groups like this is that you tend to foster groupthink, and we're smart. We can figure out what value is, and are patient enough to invest with management teams who are willing to take a step backward to take a step forward.
I think we should ask the panel in the corner of the room to maybe not end their conversation. Okay.
One of the reasons interest rates are extraordinarily low right now, 2% for the 10-year Treasury, 3% for 30-year, is that some folks believe that we're Japan, or if we're not yet Japan, we're on the road to being Japan. And in Japan, when rates got to 2%, people thought that was the bottom, and then 6 years later, they were 1% on the JGBs. So the question is the message of the bond market telling us is that there's a long-run deflationary risk out there which might really upset a great deal of pro formas that people are investing on now. Bill?
So I'd make the opposite case. I think we've had a couple 2.5% GDP growth in a world in which we're in a housing depression. And I think that is changing real time. Everything from anecdotally to, I'm chairman of the board of the Howard Hughes Corporation. We own probably one of the largest owners of residential lots. We've seen real activity in terms of builders actually signing contracts, taking down lots. A friend of mine in Cleveland put his house on the market, and he signed a contract to sell it. Things like that are actually happening. And I think if, in fact, the housing market is recovering, which I think it is, and there are lots of good reasons for why it should happen, I think you can actually see a much greater, much faster growth in the U.S. than people are anticipating. And I think the problem with Japan is kind of dysfunctional governance,
Well,
an unwillingness to recognize losses.
We are making some attempt to prove that we too could be very dysfunctional in our
No question, but I think, but still, if you look at Japanese corporate governance and you compare it to here, and you look at the ability of shareholder influence versus the Keiretsu type system, I think we still have a system which heals itself much more quickly than Japan. So I don't think we're Japan. I think we're going to have a housing recovery, and I think we're more likely to have inflation than deflation.
Okay, John, if we take the other side of that, and let's say we're going to have a housing recovery, and if we get a housing recovery, we'll get another extra percent at least to GDP, and then we get higher rates. And say, let's suppose interest rates normalize a lot quicker, and we go from 2% to 4% in like 6 months. Because when the bond market moves, we all know it moves much faster than we can imagine. It just moves much faster. It doesn't move the way it does in the econometric models. So what does that do to cap rates, financing, and the whole apple cart right now for the pricing structure in real estate?
Yeah, I would say it's a function.
Joe also afterwards. But even you, John, you go first.
Sure. The movement in interest rates, I think it's a big function of how it happens. So if you take a different scenario, if we had an Italy-type situation where rates run up and you have a contracting economy, I think that's pretty difficult for almost every asset class, treasuries, stocks, real estate. If it's as a result of growth, I think you've got some cross currents there, because what you'll see in an environment of limited new supply, I think you'll see occupancies and rents increasing, which will be beneficial. On the other hand, some cap rate pressure upward may be there. I think, once again, if you say what's most at risk, if I have a 10-year fixed leased asset, that's most bond-like and has the most embedded risk. If I bought a resort hotel whose income was down 80%, who may benefit greatly from this, or if I bought an empty office building that I thought I'd lease up to a 9 or 10% yield, and so I have a big spread relative to where I'm going to sell it, I think you've got a little more cushion. So risk-return-wise, if rates move a lot as a result of growth, the more fixed income-oriented assets are more vulnerable. And obviously, shorter lease assets, hotels and apartments do better, I think, in that kind of higher interest rate, higher inflationary environment.
Okay, Joe?
First, I agree with Bill on the macro, and I'm a little more bullish on the residential part of it. I mean, this is happening already. I think one of the biggest questions for real estate investors today, if you play the probabilities and say that we're looking at higher rates, higher yield curve over the next 5 years, how does that affect your investment strategy? I think that's the single biggest question that's out there. And I don't have all the answers, but I think I know what you want to own. And in one category, it's property types with pricing power, and it tends to put you into places where there are barriers to entry. And I think there could be another end of the spectrum too, which may ironically take you to some of the suburban and the unloved property sectors where you've got a very high cap rate, and so you can suffer some cap rate spread compression versus the cost of debt, and you have that opportunity if the economy is getting better, which would go along with the rising yield curve. I think that you could have some winners there too.
Okay, let me follow up on the housing side. If say single family starts doing a lot better, and we're also in a world right now in multifamily where you could make up anything you want for a pro forma and probably get it because the property type is so hot. Can you see a situation, say sometime in 2013, where housing is back to say 1 million starts? Multifamily is very strong in terms of starts, but people are finally moving out of apartments into single family, and all these pro formas blow up in the middle of 13. Can you visualize something like that? Anybody?
Absolutely. And one of the things that is that I'm most concerned about is you're already seeing development in apartments, and you're seeing it by commercial players, right? Office owners who are now great apartment developers, and I think that's one of the most important warning signs you should look at. But it's still, I think, early in that cycle. But there are a lot of factors that should start to cause some yellow flags in apartments. One is the affordability of single-family homes. Second is increasing development. So,
do you have a comment on
higher
that?
taxes? right?
in
The
higher
benefit of the mortgage interest deduction is one of the most valuable subsidies that we give in America, probably the biggest to the typical man on the street. And if you look at the relative, I mean, the reason why people haven't bought homes is if you're concerned you're going to lose your job and you're going to have to move to another market, you're not going to buy a home. Once the unemployment rate comes down low enough, and I think we're at pretty close to that fulcrum point, it makes a lot of sense to buy a home. And the relative affordability when rental rates are compounding at 8 or 9%, housing prices are down 50% or 35 to 50%, and then interest rates, the 30-year mortgage you can borrow under 4. I mean, that's probably also down 30 or 40%. So the only thing that's going against you is probably real estate taxes, which are deductible. So I just think, and people are, 2 years ago I put out this little paper saying investors should buy homes and rent them out, and we're seeing a lot more of that activity now. I just got a copy of a prospectus on my desk. FBR is raising a $300 million REIT for someone to go buy homes and rent them out, and it's a 9% yield proposition in a lot of markets, and I think that will help. Another thing that will assist the housing market from recovering. Zell, I think, is doing some substantial things in buying single-family homes and renting them out. So it's an interesting asset class.
John, do you have a comment?
I agree. I hate to agree with everybody, but look, I think housing is simple math. It's no different than the commercial real estate. We are adding 1.1 million households, and between multi and single family net of obsolescence, it's like 500,000 new units. So we're short 600,000 units. There's an overhang of 2 to 3 million homes, and at some point this market will come into balance, and when it does, like all hard asset classes, it'll revert back to replacement costs. People will start building again. So I think as individual investors, the challenge, of course, institutionally is how do you execute on that to take advantage of it, but as individual investors, I do think it's a good time to buy single-family homes in the U.S.
You buy lots,
Yeah.
right, from
In Las Vegas. Sam
I got some
Zell.
lots.
Yeah.
Sam Zell is going to close the conference today. At the beginning of the modern REIT era, said bigger was better, but he backed away from that in an article on Equity Office earlier in the year, in New York Times piece. Now my question is to Joe: Is bigger better? And also, in the light of what Steve Roth said,
Depends on whether you're talking about real estate or other things.
real estate.
Real estate, okay. Joe.
Okay.
I suppose there's a great efficiency curve on how big you should be, and there's a law of diminishing returns applies, but we're focused most on how profitable you are rather than how big you are. But I think the answer is generally size works against you in terms of creating value. The bigger the denominator, the harder it is to make money, but it very much depends. If you look at Simon Property Group, the biggest REIT that's out there, they're in a sweet spot right now that's incredible, and it's because they focused on generating or creating a platform that generates great internal growth. And they over time they worked on it. They paid the price by buying a lot of low cap rate assets. They went into another business, the outlet center business, and as a result, they have terrific internal growth, and they're in a great position to acquire and add to that internal growth. So, here's a situation, and it's unique to that business too. The shopping center business,
there are economies of scale in the mall business,
and it crosses borders as well. And so you can't generalize about that question. It depends on the business.
Let me ask you, is Vornado too big?
Pardon me?
Is Vornado too big?
Again, I think it's, I think they lost.
Steve said everything's on the table, so you could comment.
Look, they made some investments that haven't turned out as well as they should. One of the downsides of the size, I think you lose some of the focus on maximizing profitability and return on equity. I thought he wrote a great letter on his annual report, and I'm confident they're going to fix it.
You're being a chicken.
Actually, I'll give you an advertisement for John. I mean, I think that
Okay.
if you're, I think scale is a very significant asset if you're a real estate private equity fund. I mean, I look at, the number of people willing to invest $1.5 billion of equity in a transaction is in a very small list. And you would think, sovereign wealth funds or pension funds have a ton of assets, but even the big sovereign wealth funds writing a check of more than $500 million. It's kind of like a psychological sort of barrier. And, Centro, I sort of watched the transaction happen, was not a particularly contested deal. So I think that there is, if you look at the real estate private equity space, there are very few players. You have an asset class that's enormous, and there are people that need to move big things. And I just think that there are real scale economies and inefficiencies. So that's my pitch for the Blackstone Real Estate Equity Fund,
Let me-
12 or whatever it's called.
Thank you, Bill.
Let me follow up on the pitches. You've raised $10 billion for 7, and you may raise a couple of more billion. I don't know what you could talk about or what you can't talk about here, but what's the mission for the new fund?
Well, I think the mission's what I've been talking about, which is continuing what we've been doing, which is buying assets related mostly back to the 05, 07 period. We've been doing lots with banks. We bought from U.S. financial institutions. I think Europe is very interesting. We haven't talked about that, but clearly in Europe, you've got banks who've got $2.5 trillion worth of real estate debt on their books, and they're going to have to reduce the size of their balance sheets. So that's going to create interesting opportunities. Obviously, Europe has economic challenges, but once again, if you can get into hard assets at big discounts to replacement costs, we think it's interesting. So I would say it's generally dealing with over-leveraged assets from the banks, over-leveraged assets bought by real estate private equity firms. We've seen a number of both U.S. companies, Australian, Israeli companies who've decided to focus back on their core businesses, which is creating opportunity. And as Bill said, there's a real advantage for us in being able to move in size and scale. So I think you'll see us this year alone. We've already put out $2.3 billion of equity. We're really focused on the same kinds of deals we've been doing the last few years. And I still think in the U.S. and Europe, it's going to take a number of years before we clean up everything associated with 05, 07.
I'm going to ask a question for Joe. I want to follow up with that for you, Joe. Simon made the big acquisition in France, taking a partial position in Klépierre. DDR is in Brazil. Boston Properties is presumably buying a building in London. How do you react to U.S. REITs venturing significantly outside the United States?
Significantly, I think you have to be a little suspect of that. But as it relates to the topic of Europe, for the first time, and I think in all of our histories, U.S. companies can access capital and deploy it accretively in Europe. Historically, cap rates have always been way too low for companies to do things. I think Europe is a significant opportunity in the category of securitization. And the companies there are shrinking as a part of the global market capitalization. There are a lot of reasons for it. The management teams haven't done a great job. They haven't earned their cost of capital. As a result, the companies trade at discounts. They have a very backwards way of raising equity, and that's to do it through rights offerings. And interestingly, on that topic, I think Simon took advantage of an arbitrage opportunity to access capital here in the U.S. at unbelievable rates and in massive size, and take advantage of that opportunity. I think that you can, Blackstone has an opportunity to create companies in Europe and arbitrage that with the public market and create something that doesn't exist. I think there are alpha opportunities in that trade. I think the same thing, and we'll see if they're doing it, but I suspect that they will. Same opportunity here in the U.S. because of, when you get back to the topic of size, the depth of the buy side in the U.S. today is so significant. It would allow Blackstone and others to do what private equity does, and that's move back and forth between the private and the public market. And
in your global funds, are you over or underweight the U.S., over or underweight Europe right now?
Slightly underweight U.S., slightly underweight Europe, overweight Asia.
Okay. The next question on European investment is the election in France coming up. Does that impact your decision making if Francois Hollande beats Sarkozy?
No.
Okay. Warren Buffett has told us that the reputation of a business is sometimes much more important than the reputation of a manager, so that you don't need a great manager in a good business, and if you have a bad business, a great manager may not do all that much for you. So speaking to J.C. Penney, you have a great manager in Ron Johnson. The question is J.C. Penney a good business or a bad business?
Sure. So the answer is there are better businesses than J.C. Penney, and there are a lot worse. I would say it's certainly somewhere in the middle. But where is most of if you look at the wealthiest people in the world, what businesses do they own? The answer is they own retailers, right? Walmart, the Walton family is, as a family, probably the wealthiest family in the U.S. You look at a company like Uniqlo, you look at Inditex, find a country, there's a retailer that's owned by a wealthy family, and so if you get the box right, and you can replicate it nationally and globally, you can build the most profitable and most valuable businesses in the world. So the answer is, done right, the retail business can be a phenomenal business. I think JCPenney has been a mediocre company for 20 years, and I think Ron Johnson is going to change that. And so when Ron Johnson looked at the JCPenney story, why was he able to attract him? And I think the answer is his choices were, if he wanted to be CEO of a retailer, that was ultimately his dream, he really had to leave Apple. He wasn't going to be CEO of Apple. And what's the right platform? We could have started and gone to Kleiner Perkins and a group of VCs and private equity, raised a bunch of money. I'm sure they would have backed him to launch a new retail concept. And in 20 years, I bet he would have made a lot of progress with that business. And I think the way he looked at JCPenney, he said, look, it's a startup. It's a startup that has $18 billion in revenues, $1.3 billion or so of operating income. That's after spending $1.3 billion a year on advertising for the last 20 years. It's one of the top 20 advertisers in the U.S. It owns 40% of its real estate outright. The other 60% it leases for, generally, very, very low rents, a few dollars a square foot. It has these reciprocal easement agreements, these very valuable contractual agreements with malls that give them all kinds of interesting rights. So the real estate is basically free. So he's got a cash-generating entity with billions of dollars worth of revenue, and it makes a lot of money, and basically no net debt. That's a pretty interesting platform to launch a business. The other thing he had is he had a shareholder who believed in him. We own 26% of the company, and I told Ron, you don't need to worry about Wall Street. You don't need to worry about same-store sales next quarter or next month, or you need to do what makes sense for the business on a 5 or 10-year basis. And I think he's making the kind of changes that are very difficult to make in the context of a typical CEO. There's no other CEO at a retailer, in my opinion, that's going to go this strategy, even though I believe it's the correct strategy for a retailer. And I think that's a huge advantage for him. And so he's redone the brand, the pricing, eliminated or changed the promotional strategy, and he's about to change the product in the store. And he's doing a phenomenal job. He's also looking at the cost structure of the business. He announced, I think the company's publicly said that there's at least $900 million worth of cost to come out of the company. And this company, by the way, generates $150 a square foot, $160 a square foot in sales. So I think Ron looked at this, he's okay, at Apple I'm doing $7,000 a square foot in the same...
But it costs more than, listen,
worst case,
an iPad costs more than a t-shirt.
But think about it this way, worst case, let's just carve out, the 120,000 square feet in the mall, let's just carve out a little Apple store. Let's do $7,000 a square foot, let's keep the rest vacant, and we got a better business. And so he said, look, I can fix this situation. And what Mike Ullman did, I think the best thing that Mike Ullman did at JCPenney is he took Sephora and he put Sephora in JCPenney, and he proved that you can open up a full-price, high-brand retailer that attracts a very broad customer that was not a JCPenney customer. And that little store does $500+ a square foot and does double-digit comps month after month. And Ron's plan is basically to take the JCPenney store and to convert it into 100, plus or minus shops of very high-quality brands, and where the brand has a lot more control over the way they display their merchandise than they do Lost in Macy's or many other stores. It's a very attractive proposition for a very high-quality brand. But the problem was the high-quality brands didn't want to go into JCPenney because when you walked in, everything was 50% off, 30% off, and you get a coupon, and there's someone shouting every hour, if you buy this second, I'll give you $10 off.
But wait.
And so that damaged the very few high-quality brands want to be in that environment. And so now, because it's fair and square pricing, all that discounting crap is gone, it's a much higher quality perception. He's had an avalanche in terms of people banging down the door to get into the store. And they've actually have an application process now with vendors if you want to open a JCPenney shop, and he's made a very attractive deal with them. And I think it's a strategy that makes a lot of sense. Now, there's a lot of turmoil when you go from the old strategy to the new strategy, and it takes, he's been there since November 1, right? This is a guy who's been there for less than 4 months or whatever the time period is, 5 months. And we're prepared to suffer the short-term turmoil for what's right in terms of the long-term business. And so where you see an opportunity to take revenues from $160 a square foot to some meaningfully higher number, take expenses from very high levels to a very low number, and then you have the benefit of basically free real estate and a brand that has spent more on marketing than almost every brand in the U.S., so it's well known. And if you can reshape that message, you can have a home run. And the implications, I know it's a real estate conference, JCPenney is about pretty much in every mall. I mean, they're a big percentage of the mall industry, and they're in a lot of B malls, and they're in a lot of A malls, and they're in some C malls. But they're going to make every one of those malls better by virtue of this store turning around. So I think the implications for the mall industry are very positive. Of course, if he's successful, but we've got $2 billion bet on his being successful. That doesn't mean we're right, but we hope so.
But I assume you have patience. Turnarounds take time, and even if you read the history of Apple looks great now, but there were long periods where Apple was, even when Steve Jobs, when he came back to take over the company, was wandering in the wilderness, and it took a long time to make Apple right. So you think Wall Street will have the patience for this?
The answer is we don't really care. Ron joined Apple, I think the stock was 9. I think a few months later the stock was 6. Now, fortunately, his options are struck somewhere between 9 and 6, and by the time he left at 500, it was a good outcome. So, by the way, that was 11 or 12 years later. I think here's what I would suggest you do: you should take the Apple stock chart from 2001, and you should take the JCPenney stock chart from the time Ron joined the company, and sort of match them up against each other. And then, if you want to know where JCPenney stock's going to go, just follow the Apple chart. So. Look, I told you guys the same story. It was April of 2009. GGP was 56 cents, and I told the 500 people in the room the stock was going to go from 56 cents to $25 a share, and I was wrong. It's 26 today. If you look at the value of the pieces, okay? Ignore what I say.
Okay.
In fact, short it.
All right. Now I got a question. Can you buy JCPenney and Cohen & Steers? Is that in your wheelhouse or not?
He owns it through his Vornado position.
Through his Vornado position. Okay, let me ask Bill another question. Is GGP, they've had their recovery, they're trading where they are. Still a long way to go from their former luster. It's taken a while to fix everything. Where do you think they go from here? What's the strategy for GGP?
Well, I think they've done a very good job. We stepped off the board when the company came out of bankruptcy. And at the time, so what we did was we took, GGP became maybe the problems of scale that Joe talked about. They got kind of big and they were buying lots of different things. And there was a lot of crap lying around in excuse the expression, in GGP. Actually, I'll use the expression that John used. We spun off this company called the Howard Hughes Corporation. And while John was working with David as a competitor to the bid, he used to call my little Howard Hughes Corporation, he used to call it Shitco. And by the way, Shitco has a $3 billion market cap right now. That's a lot of shit. But my point is that there's value to be created when you take a company like, General Growth, which was in the master plan community business because they bought Rouse, so they own 7,000 acres in Vegas, and they own the a couple of communities in Houston, and they own development assets all over the country. But we took those 32 assets out. We got a great new management team, very entrepreneurially focused, has done an incredible job to date, and I think will continue to. And making those development assets, everything from South Street Seaport, which was an asset on the books for $3 million, which is, if you think about it, if you look at Fifth Avenue at $3,000 square foot rents, you have actually very similar traffic levels at South Street Seaport that you do on Fifth Avenue, except, and you actually have the second best performing Abercrombie, I think, in the whole system, but they're paying $80 a square foot. That's something very, very wrong with that. So we're going to fix that. So you have that company, and now GGP spun off Rouse, and they took really the worst of the assets, and what's left is a company with $500 a square foot in sales, and the opportunity is, for the last, certainly the last 4 years, GGP was in financial distress, and didn't make a lot of, when you're in financial distress, you don't make a lot of great decisions, and when it was in bankruptcy, Adam Metz is here, he did a fabulous job with Tom Nolan, when taking the company through bankruptcy, but his principal focus was bankruptcy, and during that period of time, a lot of people took advantage of GGP, and they rented space at very low rents, and we were smart not to sign long-term leases. Well, a lot of those leases are coming up. They're being renewed at much higher rents, and so you have a pure play, $500 a square foot Class A mall company with run by Sandeep, who's a great operator, and they're reletting space, and they're redeveloping assets, and they're focusing on maximizing the value of the portfolio. You have this very valuable embedded option in the fact that, you know, the $15 billion of debt that we extended during bankruptcy, all of that debt is prepayable at face value with no penalty, which is an incredibly valuable asset. Now, at the time we negotiated that, you know, we were financing these assets at 5.5%. You know, if you notice, GGP did a financing of Ala Moana. You know, they took out, you know, whatever, a couple $100 million of incremental cash, and I think it was like 4.1%, 10-year interest-only, you know, piece of paper. Well, there's this huge embedded refinancing option in the company. So there's a repricing of the leases. There's the repricing of the debt. There's just a much more focused, high-quality portfolio. And I think what Sandeep has not yet really established is kind of credibility in the Joe Harvey community. He doesn't have nearly doesn't have the track record of David Simon. So there's still a question mark, and that's why I think the stock is still cheap. And I love the Class A mall space. I didn't keep the Rouse spinoff. That I sold because I don't love that part of the business. But the $500 square foot dominant, you know, 1.5 million square foot mall, which owns a market, I think is a very bulletproof asset.
A few years ago, and to go back to 2008, 2009, we're in the middle of the crisis. The big worry was all the CMBS that was done in 06 and 07 was going to roll over in 12 and 13, and there'll be a real crunch time. But no one actually imagined there'd be 2% treasuries, and rolling loans gather no losses in the banking system. So my question is this going to John, is this going to be a non-event, all the CMBS maturities, or will there be opportunity in that environment?
You know, I think it's not an event in terms of a watershed moment where all this debt comes due at one time. I think it's just going to be what we've been watching, which is as debts approach maturities, they'll need to be restructuring. They've done some extensions, but many times in the trust, you can only extend for 1 or 2 years. So when you get towards the end, particularly as markets have recovered, outside capital has to come in. So we just bought a hotel in San Francisco. It was owned by somebody. The CMBS debt had come due. They couldn't get a further extension. It needed to be recapitalized. We worked with the existing owners. I think you're going to see more and more of that. So I think the pace of transaction activity picks up, but the idea that there's some huge wall of maturities that triggers a big decline in asset values and sort of a run on the bank, that's not what we foresee. We see slow and steady work through of that bubble from 05, 07.
In contrast, Europe, it'll be a lot different since they have to recapitalize everything?
No, I mean, look, Europe is more problematic for the banks there because they have not sold. In the U.S., if you contrast it, you have a CMBS market, you've got a REIT unsecured market, and you have a banking system. There, the problem is the capital providers are the banks who also need to slim down. So I do think it is a bigger issue. The central bank there has provided a lot of the liquidity, which has slowed down any sort of big panic or moment. But same issue exists there, and I think over time you're going to see a lot of distressed assets sold. We bought a bunch of them the last couple of years on hotels and shopping centers, multifamily assets in Germany, and I think the pace of that will pick up over the next couple of years.
So more opportunity in Europe than here, then?
I'd say big opportunity in both. They're probably earlier stage in terms of where we are, and it's going to play out over a longer period of time.
All right, questions from the audience? Has to be some. Yes, sir. The question is to John, whether in Europe, are the assets distressed or the sellers distressed, or both?
I'd say it's both. We bought a number of hotels recently from a UK bank who'd foreclosed out the partner. The assets were performing fine, but not where they had been pro forma'd, where the financing was done. We do also talking to European owners who have other businesses who need to deleverage. So in some cases, it's they themselves. And then, you know, operating performance in Europe is tougher. So the hotel business is not performing as well in Europe, for instance, as the U.S. Leasing in some of these markets, particularly the southern countries, there's big contrast today, as you can imagine, between Germany and, let's say, Italy. So in some places, operating performance is really tough. In a place like the UK, London is actually pretty good, but when you go outside of London, things are much, much weaker. So there's a range of sort of operating performance. I'd say the big problem's really along the lines of the U.S. There's just too much leverage against these assets, and that amount of debt is not refinanceable. And so that's going to lead to a need for a large amount of equity to come in to recapitalize those assets. The challenge in Europe is, the question posed earlier is the U.S. going the way of Japan. I think in the U.S. we're adding 3 million people a year. Japan's declining by 1 million people a year. I would contend that we're not going the way of Japan. Europe, some of those countries face some really challenging problems, both economically and certainly demographically. And so I think in Europe you have to anticipate low growth and low interest rates for the most part. Obviously, some of these countries have sovereign risk, but I think you have to anticipate a pretty challenging environment. And so I think it's imperative that your asset pricing reflects that. We just bought, as part of a big bank portfolio, some NPLs in Italy, and our price was cents on the dollar for the NPLs. Now, Italy's very hard to enforce on, but you have to be very conservative in some of these places, just given the overall economic picture, and there's some regulatory challenges in some of these places as well for folks like us. So I would say, as a general matter, as investors, wherever there's a high amount of distress and a limited amount of building, those are interesting places to play, and I think Europe fits that bill today.
If I could add on to that, I think one of the reasons that distinguishes Europe from a distress standpoint is that equity is not being injected into the system, and the banks are trying to delever by selling off assets as opposed to raising equity like our banks did here in the U.S. And I think we're going to have continued, fits and starts, mini, contagion in Europe until we raise equity. And that provides an interesting opportunity for private equity and listed real estate companies as well to help recapitalize the real estate sector, which is so closely tied to the banking sector.
Rafi.
So I would say that's true for every, retail generally, right? The internet is becoming a more and more important force in retail and a more threatening force in retail in certain spaces than others. I mean, I think, if you think about Best Buy's business, I think, if I had to have a target on a business where there's a huge threat to the business, who wants to go in and deal with a salesperson on buying a flat screen TV? It's basically a commodity product. It's a pain in the ass. You can't even fit it in the back of your car. Why not just, look it up on the internet, get the best one, get the best price, not pay sales tax, and have it delivered? What Ron's doing, but you have to pay use tax in New York. I pay my use tax, in case the AG is paying attention. But the, I always assume that. It's the way I live my life. But the, based on the history. Of course, I lost my complete train of thought. But so one of the benefits we get with Ron is he comes from Apple. Right? Now, what's interesting is you would think that a retailer like Apple that sells, the Apple iPhone, you would think, this is a kind of product great to sell on the internet. And Steve Jobs decided to implement a retail strategy after every other computer retailer had failed. And the reality is, built the most successful retailer of all time. And why is that? Well, it's not because they sold the product at the lowest possible price. You can actually buy iPhones and iPads cheaper at Best Buy or Target or Walmart or other places. People want to buy in the Apple Store because of the experience, because of the environment, because it's social. I had the opportunity to have dinner with Robin Williams. He met his wife in the Apple Store, right? So it's a place to meet girls. I mean, it's, look, I won't get to my whole theory of what drives human behavior, but the reality is there is something to be said for the social experience of retail if it's an attractive experience. And I think one of the things that's attractive about apparel retailing, it is one of the categories where the social elements and actually trying something on and seeing what it looks like and going with a group of friends or a mother and a daughter, there is I think an attraction to that. Ron is talking about creating what he calls the town square in the middle of the store. I mean, making it a place where you want to go for a reason. But if you're selling commodity product that's delivered for free and you don't have to pay sales taxes, I'd be very nervous about that strategy. But internet, look at Macy's. Their internet retail is growing at like 35-40% per month. It's an enormous number. They've gotten it right. It's a big driver of the overall same-store sales of Macy's. JCPenney, our internet retail has basically been flat for the last couple of years because we have a huge head start because we had this catalog business, but the company didn't think about, they took their catalog and put it online as opposed to built a internet strategy de novo. And Ron, by virtue of his experience in technology and his relationships in Silicon Valley and so on and so forth, I'm quite confident we're going to have a best-in-class website. We have a head start with $1.5 billion of sales on the web, which is one of the biggest internet retailers already, and that's with a website that's not that great. So you can expect to see dramatic improvements online, as well as and the connection, by the way, between online and bricks and mortar. You can order online, and then, you know what, you don't like it, you can return it to the store. And by the way, you walk into the store, you see something, and then you end up buying more. That synergy is a very attractive one. So I think what will happen, when I don't know if you can think this far back, but when the service merchandise, I don't know, the catalog stores, 1-800 number and a catalog, who's ever going to shop in a store anymore? And catalog retail picked up some percentage of retail sales, but it's not going to, not everyone's going to buy everything on the internet. What's going to happen is the best retailers are going to adapt their business models to make an attractive places to shop, and they're going to have a companion internet retail that takes advantage of the synergies of having, whatever, 1,500 stores around the country or that kind of nexus with the consumer. So I think it's a net positive for certain retailers and the death warrant for a number of them.
Next question.
Like Borders. Yes. I guess why don't you go? Go ahead.
Sure. I think there are a couple different questions in there because maybe there's what type of businesses can you put into the REIT structure, and then how can you use the restructure to financially engineer something to try to create value. On that topic, the latter, I think there's been way too much focus and attention put on that. I'm not a fan of that. And I think there are moments and times when people can effectuate a transaction, but typically the idea of separating the real estate from an operating business, where it in many instances is very critical to that business, I don't think that's a great idea. As it relates to putting businesses legitimately into the restructure where it qualifies, like American Tower, I think that's terrific. I mean, there's a net present value of tax savings, and if it legitimately fits in the REIT structure and it's a good business, then we're all for it.
Let's finish.
In Target's case, it was kind of a unique circumstance in which they own effectively all of their real estate. It's in very high quality locations, and we came up with a structure that I thought would be extremely interesting to the REIT community, and also allow Target really not affect their business. Basically, our idea was to take the land under every store, contribute it to a subsidiary, set up a 75-year lease between the land and the real estate, and spin that to shareholders and create an unlevered, extremely safe, what we call TIP REIT. It was Treasury Inflation Protected REIT. It was designed to look like a Treasury Inflation Protected security, where the rents would go up by a CPI adjustment. We pay rent twice a year on the same days that you get the dividends from your Treasury security. That what I liked about it is it was a very efficient way for Target to, that entity was worth, in our opinion, basically the entire market cap of Target, and it wouldn't affect Target's business. It would give them the benefit. You keep all the real estate in the C Corp, where you get the benefit of the depreciation, the complete flexibility in terms of modifying their buildings. They get the benefit of effectively, paying a deduction for their land, and I think you have something that would be the largest cap REIT at the time in the sector, and something that would be very, very safe, no risk of. So I thought it was a unique circumstance. I don't think it applies. There's not another company I'm aware of for which that kind of structure applies. Case of Corrections Corp, there have been some developments in the REIT tax law that may make it possible for a company like Corrections Corp to convert to a REIT without spinning off a separate operating entity. And if you don't have to change your business, I mean, the mistakes that people make, they enter into some sale-leaseback transaction where it looks great for 19 years and 11 months, and then all of a sudden you lose control over all of your real estate and you're out of business. And I think it's got to be, so I agree with Joe, it's got to really fit to the business, and if it's a more efficient way to be structured and you don't have to change the way you operate, it can be an excellent solution for a lot of people.
Okay. Thank you very much, everybody.